Good afternoon, traders. It's Bill Baruch with Blue Line Futures Intradaily Midday Market Minute. We got a hawkish pause from the Fed, but before I get to it, if you're watching this on YouTube, please click the link below and subscribe. Like and subscribe if you're watching from our website. There's also a link below to direct you to YouTube, and you can subscribe that way. We'd love you to follow us. We'd love you to help us build our following. All right, let's get to it. Now, we got a hawkish pause or a skip, whatever you want to call it. Fed did not hike rates today. They left them at 5 basis points. However, the big thing here from a hawkish tone was that they now forecast a terminal rate later this year of 5.6%. That means they are saying 2 more 25 basis rate hikes. That's what sort of sucks some wind out of the risk environment, had a little wiggle in stocks. You had some of the other commodities trade a bit lower, but overall, as you digest this, I think the most important thing to understand is of the parallel that I've talked about it more than a few times this year. Looking back to 2018, when the Fed hiked rates in December, 25 basis points, and the S&P was already down 17%. At that moment, they said they're going to hike 2 more times in 2019. They never hiked in 2019. Instead, they ended up cutting rates by July. The reason why they have to say this narrative is to manage the market's reaction function. If they did not hike rates today and they left that terminal rate unchanged, you're going to see the market go gangbusters. You're going to see the NASDAQ and some of those AI stocks continue to melt higher. And overall, you're going to see commodities trade higher immediately, and that's what they're trying to avoid. Ultimately, this does buy them time to see if the economy is going to continue to slow. We have a lot of data coming out over the next couple of days. This Fed meeting, this Fed decision was the belle of the ball, but we still have a lot going on here. Tonight, a deluge of data coming from China, unemployment, industrial production, fixed asset investment, retail sales, a lot of data to digest there. If this comes in poor, we could actually hear China talk a bit more about stimulus or rate cuts, so that's something to keep an eye on. It has not turned a corner yet, but there is some signs we could start seeing their data turn a corner. New loans was softer than expected, though it rebounded from the prior month. This was a data point that came out on Tuesday morning. So keep an eye on this data tonight. But overall, we've seen the equity market finish back at near session highs. The NASDAQ is making session highs here in the after hours as I'm talking. We had a little wiggle in the S&P. It went down to 43.83, which basically was the low from CPI. Now, remember, CPI is before the opening bell. So on Monday, the market closed at 43.88, and before today, that 88 was not covered. The market did not close below that or trade below that area, into that area yesterday. We did. Now there's a line in the sand that can be really built off 43.83. You have that low from CPI, and you have the low today. And there's been quite a bit of volume that's traded there. We've seen it where if the market starts to elevate after a wiggle like this during the Fed, and now you get a line in the sand, and we could start trading higher. You know where that line in the sand is now. It can manage risk. As well, we closed above 44.09. That's the level I've been talking about. You want to see a continued close above 44.09 to pave a path of least resistance higher for the bulls. Now holding above 43.88 makes the bulls are in the driver's seat while the market stays above there. And then overall 43.25 to 43.40 is a big level that if we start going below 43.83, then we have to hold 43.25, 43.40, and that would encourage a consolidation, which is healthy. It's healthy to digest the gains after a move like this. So where do we go from here? A lot of data. Tonight starts with China. Then we go into tomorrow, the ECB, retail sales, initial jobless claims, Philly Fed, New York Empire State Manufacturing as well. Those Philly and New York numbers, they've been softening quite a bit. The initial jobless claims are starting to tick up a little bit. See what we get from the ECB. We know the consumer could be struggling. So some of this data, if you're talking and looking for data that could be slowing and really kind of help the risk environment a bit, this is it. I mean, so let's see what happens here today. Now, the dollar was a little bit lower, but it didn't really help commodities too much as gold and crude oil both finished lower in the session. But lastly here, like I said, the NASDAQ, said earlier here, the NASDAQ is making new session highs into the close. There is some resistance here. I mentioned a lot of levels in the S&P, but everything for the S&P and the NASDAQ are on the Morning Express. So check it out. Don't miss that. That goes out every morning. It'll be updated tomorrow. But for crude oil, this was not a bullish report. This was fairly bearish. We saw crude reject the $70, did not close above $70. It's the level that we've had as big resistance, and we didn't close above it. You got to get above there to really start to manage the repair of the market from that fallout earlier in the week. So that's the level of the line in the sand. There's some other levels to highlight that are on the Morning Express. However, to point to today's report, 7 million barrel build, 2 million barrel build of crude oil. I'm sorry, 7 in crude, 2 in gasoline. But you had SPR, another 2 million released from SPR. But net imports were actually down, so it wasn't flooding the system. So this was a fairly bearish report. A tick up and implied oil demand, however, tick down and implied gasoline demand. Just some wonkiness out there. Let's see how the market reacts. China's data tonight will be crucial for crude oil, as well as looking at the metals. That Chinese yuan, which is back at session highs, that 717 area. So as this trades higher, remember, this is CME traded contract. CNH is the symbol, but it's the USD CNH, which means this higher this goes, it's the dollar strength it's highlighting. The weaker it goes, it's highlighting yuan strength. As the dollar strengthens against the yuan, what that means is it's going to hold back commodities, and that's been a big headwind to gold, silver, and copper. Now, gold and silver have traded higher in the session. They settled in a bit. Off the worst levels, silver did a little better, but this could, you would have liked to see more given what the dollar did, although rates did tick up a little bit. That 2-year actually finished in the red in the session, though off the best levels, off of the worst levels of the day. But that 2-year yield, watch that. And then remember, though, the CPI data yesterday, I highlighted it. CPI is slowing, so narrative there is the Fed may have to hike less, which they won't slow the economy as much. We get a soft landing or no landing, and then it means less demand for safe havens potentially, but industrial metals can really capitalize off that. Copper is moving into it's a big area of resistance, 380 to 390, traded as high as 387.40 today. See if we can't get above 390 if this China data is better than expected tonight. Keep an eye on it. Again, it comes at 9 p.m. Central Time. Our team is here to help, so don't hesitate to reach out. There's a lot to unpack here. Give us a call. Give us a shout. 312-278-0500. Remember, futures trading involves substantial risk of loss, and it's not suitable for all investors.